Today, we've got a question from one of you who wants to know about valuing a business that doesn't come with any equipment. Does that affect the price? I mean, what's the process? How do we even think about that? We're going to explore that coming right up.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
And speaking of Business Buyer Advantage, don't forget for the month of January 2025, I'm making a $150 donation for every new enrollment to the Build Back Black Mountain Fund to help natural wilderness spaces in the Asheville, North Carolina area recover from the Hurricane Helene devastation that occurred in the fall of last year. That's for this month. So let me talk about the email that I got from Jerry. So I'll put it up here on the screen. So Jerry writes, "Hi David, I just wanted to say that I really enjoy your videos on YouTube. Thank you, Jerry. The amount of knowledge you bring is so helpful to us small business owners. Here is a question I'm not sure I've ever heard addressed. How do you value a business for sale that has no FF&E, that which stands for furniture, fixtures, and equipment? For example, I'm looking to purchase a baking company, but they do not own any equipment in their facility. They rent a shared commercial kitchen space. In this case, is it fair to use traditional 1.5 to 3x formulas if there is no FF&E? Wouldn't it value for less than those multiples? Basically, it's the goodwill, systems, recipes, and customer list that I would be purchasing. I know my accountant loves FF&E because he can write it down in the first year. He's talking about bonus depreciation in the US. So this type of deal provides me with no advantage in that way. Any help you can provide is greatly appreciated. Have a great weekend, Jerry." Awesome. So this is great. Thank you, Jerry. I appreciate the great wishes and the question. So, um, how do you value a business? Well, the methodologies that value a small business kind of fall into three different categories. There's what we call the income methods, which are driven mathematically. So it's what sort of rate of return should an investor be looking for, and there's different formula that use EBITDA or SDE, and there's others I've mentioned over the course of time. And then there's methodologies that fall into that category that are more apropos for larger companies, like discounted future cash flow, et cetera. So that's sort of the income method where you take a cash flow level of some degree that you determine, and you apply a methodology for what kind of rate of return you require, and then it comes up with a number. Okay. And so, what is that number? All of these methodologies are trying to come up with what is called the enterprise value, which is supposed to be the value of the business as a going concern with all of the things required to make it go. And I guess what Jerry's concern is that some of the stuff required to make this business go, the mixers, the ovens, all that other kind of stuff, aren't property of the business. It's leased, right? So does that have an impact? Well, maybe. We're going to get into that. The second grouping or category of methodologies to value a business would be market based on market observation. So this is where we look at databases of past sale transactions and we see what have other people paid for when they bought these small bakeries, right? So I did a quick search on a database. I'm not going to show it on my screen because it would violate the terms of service I've signed up for. But I'm looking at about a dozen small bakery businesses that have sellers discretionary earnings between 70 and $80,000. So these are smaller ones, and I'm guessing this is a smaller one because if you're operating from a shared commercial kitchen, you're not monopolizing the space, you're sharing it with other people, right? So I'm looking at rather small businesses, and these businesses have total revenue between 200 and 500,000 in this range, okay? And so what these businesses have sold for And I'm looking at transaction dates that are about 70% of them are since 2020. Okay, so they're pretty new transactions. And the lowest one I see is 1.39 times SDE, and the highest one I see is 2.25. Okay, so that's kind of the range for these small bakeries. And in the market, um, in the market methodologies, what we're doing is we're taking the SDE of the business at hand, which Jerry didn't provide, but we're looking at that and we're comparing it to these other businesses and we're multiplying it out. And what this is telling us is this is what other people have paid for a similar cash flow in their transaction. And so we look at that as a measure of riskiness for the particular kind of business, in this case, bakeries. And these multipliers would be very different if we looked up another kind of business. Like if you looked up like a septic pumping business or something like that, it would be very different. Okay. And then the third sort of grouping of methodologies has to do with replacement cost, where we add up the value of this stuff in the business. And this is where this business would end up with a very low number because they don't own much, right? So as he pointed out, they've got maybe a certain degree of inventory, which is probably quickly replenished on a just-in-time basis. For something like baking, it's readily available, flour, sugar, all that kind of stuff, and then the customer lists and all that kind of thing. So what what do we do when we look at this kind of business? Well, a couple of things. Um, what you're buying, Jerry, is you're buying a cash flow, right? So I would kind of discount the replacement cost methodologies, and I would look at both the market observation methodologies, the market data methods, and here's a range for you, like 1.39 to 2.2 is kind of where it is. And then I would also consider, what sort of rate of return you need from the business, and that would be sort of the income methodologies. Now, here's the interesting thing about this business. Most small businesses of the kind that I'm describing, because again, I'm assuming it's a pretty small business if it's operating from a shared commercial kitchen, are sold on multiples of SDE, seller's discretionary earnings. Out of the SDE cash flow, the owner of the business has to do several things. Number one is pay themselves a fair market wage, or a manager, right? So, because seller's discretionary earnings is the amount of money available to an owner operator that works full time in the business. And it's after we've gone through different add backs like depreciation and amortization. Depreciation and amortization is how accountants account for things wearing out. So, when we have seller's discretionary earnings, the owner's got to take a paycheck, number one. Number two, you got to take into account any debt service. So, your principal and interest payments if you borrow money to buy the business. Number three, you've got to pay taxes. So you've got earnings, you're going to have taxes to pay. Taxes have not been taken into account. It comes out of SDE. And then you've got to get some kind of rate of return on the money you put in the deal. And some people are happy with, sort of the principal pay down on the debt being their rate of return on their own money. In which case you really need to wait until the debt is paid off before you kind of get a return on your cash, whatever that was. And then the last thing is capital expenditures. Because if we added back depreciation and amortization to get SDE, it means that if a machine breaks, that machine has to be replaced from SDE. And there's two ways that you can replace a machine. You either pay for it with cash, right, which comes out of your seller's discretionary earnings, or you're going to lease it, or you're going to get a loan for it, in which case the lease payment or the new loan payment has to come out of your cash flow, out of the SDE. What we're looking at here, because of the way this business is set up, is we're looking at a business that has no capex because they've entered into a rental agreement with the commercial kitchen where they're renting the space and all the equipment together. So my presumption is that if the Hobart 60 or 80 quart mixer were to break, it's the owner of the commercial kitchen that has to replace it or repair it. Right? So this is where it's kind of interesting because while the opportunity for depreciation is not there, as Jerry points out, I would say that the seller's discretionary cash flow created by this business is in fact more solid and more resilient than a normal bakery's cash flow resiliency that would be subject to the threat of sudden capex needs if something important were to fail. right? So there's arguments here to say I'm going to make an offer on the lower end of that multiple range because there's no equipment. Sort of people kind of see equipment or assets in a business as like a plan B. Like if you pay 150 or 200 grand for a business that owns $20,000 worth of equipment, then you say, well, if the business fails, I can just sell the equipment, right? It kind of creates that plan B opportunity. We don't have that here. And so you might say this is going to make me want to offer a lower multiple for the cash flow. But at the same time, we know that we don't face the risk of sudden capex expenditures, which to me is then a positive aspect. Now, if you buy this business and you just keep it small like it is today, you enjoy this cash flow resiliency. But if your goal is to grow the business, likely you're going to max out the capability or capacity of the commercial shared space. And you're very quickly going to realize, hey, I need to create my own production facility, in which case you'll be faced with, uh, you know, giant capex costs because you're going to have to buy your own oven. You're going to have to buy, maybe fit up a leased location. You're going to have to get all of the stuff that you're getting in your rent today. You're going to have to acquire on your own potentially. And that's going to cost a lot of money. It's going to be like investing in a whole other business, right? So positives and negatives, absolutely. Um, what I would do is I would say in this particular scenario, hey, I'm getting very little in the way of hard assets. So I would have a instead of it affecting the price I'm willing to pay, I would have this impact more the terms of what I was willing to do in this deal. So I would explain to the seller, hey, because all I'm getting from you is relationships and customers and recipes, and I'm not getting anything in the way of hard assets, I don't feel as comfortable borrowing as much from a bank. I will give you a down payment that I can afford, and maybe I will, ask you to finance the balance. So maybe you could use the fact that the business has very little in the way of assets to secure yourself better terms by way of a larger seller financing note, potentially, right? Um, or something like that. But generally speaking, whether or not the business owns equipment doesn't have an impact on those first two groups of business valuation methodologies, being that the income method is based on the earnings and the direct market data is based on what other people have paid for similar businesses. Has a huge impact on the third category, which is the replacement cost, sort of cost to recreate category of methodologies. Um, at the end of the day, what do you have to do? At the end of the day, you have to create a cash flow forecast so that you have to see what will this business do for me once I'm the operator and owner of the business. So you have to take into account, what kind of salary you need, what other expenses may have been added back or what have you by the person selling the business. And you have to forecast it out to make sure that this is going to make sense for you and that the amount of time and effort that you're going to put into this business is going to make sense for you, right? And so, um, if you have trouble with that, my suggestion would be that you head over and sign up for my cash flow forecasting program. And that is over at bizplanschool.com, bizplanschool.com, where you can learn, people who enroll in that program can learn all about how to build cash flow forecasts. And that leads you then into building the business plan, which can be used either for securing financing or getting investors or whatever, what have you. Um, but it's a great question. At the end of the day, when we're talking about enterprise value, we're talking about the value of the cash flow. And so, if this small little bakery business has been producing an eddy steady cash flow for years and years and years, that is seems to be really reliable and dependable, and that's what you're buying. And as we've said, we've got resiliency here against unforeseen capex expenditures. If the rent that they pay simply includes access to the equipment and it's somebody else's duty to repair or replace that equipment when it fails, I think that there's a lot of positives to this business. It can be very good. Again, if you plan to keep it the size it is, and you're always going to be able to use that commercial rented space to satisfy the production needs of the business. Anyway, thank you very much, Jerry. And thanks to everyone who's tuned in. If you have a question, put it in the comments, send it in by email, reach out via social media. I'd love to get your questions and to answer them here on YouTube videos. And with that, I'll say see you later. And we'll tune in next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy! Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.